Good evening, everyone. It is my pleasure to welcome you all for today's session on what's next in IFRS. As the global financial landscape continues to evolve, IFRS have played a crucial role in harmonizing accounting practices and enhancing transparency in financial reporting. Over the years, IFRS has become the standard for financial reporting in many countries, aligning diverse accounting frameworks and facilitating cross border transactions. However, as the business world faces new challenges and complexities, the question arises, what lies ahead for IFRS? I, CA Ashish Subedar, Chairperson CP Committee, welcome you all for this great evening. Before we begin this event, we would like to thank His Majesty Sultan Haitham bin Tariq, our sponsors CBFS, our corporate supporters and corporate members. I request everyone to stand for ICI motto song.
यशस्सुप्तेषु जाग्रति यशस्सुप्तेषु जाग्रति कामं 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 कामोषो पुरुषो निर्विमानः तदेव शुक्रं तदेव शुक्लतब्रह्मा तस्मिन् लोकः सन्तोषः सर्वे
Thank you. Please be seated. Now I request our Chairman CA Jim for his welcome address.
Respected members, past stays, our speaker today, all guests, welcome all of you to this first session of CP event. So when I stand here, one thing come to my mind which happened this year when our President and Vice President visited us. So we got the opportunity to meet Excellency Pankaj Khimji with President and Vice President, and when they were discussing about different topics. So Excellency was talking about our union ministers, especially about Piyush Goyal ji. So he was talking very high about him. So in between, the Vice President told the Excellency, sir, he's a chartered accountant. So he said, is it? Then President sir said, yeah, he's my member. So the pride with which he said created goosebumps, really. So when I stand here as the 16th chairperson of ICI Muscat chapter, in front of my members, I stand with the same feeling. So I take this opportunity to thank each and every one of you on my personal behalf and on behalf of all the MC members for giving us one more opportunity for the year ahead. So I can see Sajeev is relaxingly sitting there. So I didn't see such a smile in his face during last 1 year. So when we work with ICI for the positions like chairman or secretary or treasurer, we are always on task. Okay, we cannot take leave. Any time any member will approach us. So similar way it will be a part of our life. So it will be like a second wife. So when Saji was working, I felt like it was his first wife. So he started a lot of initiatives. So we are first priority is to start or complete whatever he started. We have started a lot of good initiatives like the CFO training program. Whoever agreed to join that, we have formed a committee. We are working on the back papers. We are working on the presentations. Hopefully this will start from August first week. So any members still there is a chance to join, hold hand with the ICI to support the society. Anybody interested, please join us. Similar way, we started the members premium benefit plan. That also we have added a lot of vendors. So any of your organizations interested, still there is chance. Similarly, we were working on GCC conference. Hopefully that also will happen this year. So we need your support. And as far as ICA is considered, this year is a year of celebration. Not because I am the chairman. This is our 75th year of existence. So actually, Institute is coming up with the 32 weeks plan. So which will start from 1st July till next year, I think February 9th. So it's a 32 weeks plan which is prepared to celebrate this big event. And we will align our CPE sessions and our programs with that also. So that will roll out soon. And last year we had the VOCA, the Olympics of Accountants. At least 20 of people joined from here. It was a big event that was happened in Mumbai. So this time Institute is coming up with another big event which is called GLOPAC, Global Professional Accountants Convention. So last year it was Olympics, this year Institute called it as IPL of Accountants. So 7,000 people joined last year, this time planning with more than 10,000 people. So it will happen in November 24 to 26 in Gandhinagar, Gujarat. So we are planning to support the members. We are planning to offer some early bird discounts like last time we did. So that is also happening. Then another big event is happening in Abu Dhabi. It's a World Investment Forum 2023. So Institute is associating with that also. That also will be published soon. All these are in pipeline. So this will be a year of celebrations. So going ahead regarding today's session, so we were also thinking what to do because we had some soft topics last 2-3 times. We had on yoga, we had on ChatGPT. So this time should be a technical, serious session. So everybody came up with the IFRS. So when we talked about IFRS, first name came up is James's name. So I know you are not here. So we tried to reach him. He happily agreed. So first session is IFRS, and the topic also I was discussing with him, sir. IFRS 17 is also applicable. So what is next? So he said, okay, let's do it. What's next? So let's hear from him. What's next? So I welcome all of you to this event. Thank you very much.
Thank you, CA Jim. May I request CA Badri to introduce today's speaker, CA James Ravi.
Good evening, Namaskar. On behalf of ICI Muscat chapter, it's my great pleasure and honor to welcome you for the first technical session under this new management committee. And today's speaker is known to each one of sitting here. So he doesn't require a formal introduction, but as part of our protocol, it's my pleasure to introduce speaker of this evening, CA James Ravi. In fact, way back in 2013, I remember I attended a crash course on IFRS, 7-week session, in which Mr. Ravi also gave a full day session in one of the week. That time he was the regional director at ICI Muscat chapter, ICI Dubai office. So let me introduce formally CA James Ravi. CA James Ravi is a fellow chartered accountant and CPA. James Ravi is a highly experienced professional in the field of finance and accounting. Currently, he holds the position of Director, Audit and Assurance in Kuro, Oman. Prior to this role, he worked as a consultant IFRS Educational Services for Ernst & Young India. He has also served as the first Regional Director, Middle East for the Institute of Chartered Accountants of India based at Dubai. With a career spanning over 30 years, James Ravi has developed a wealth of knowledge and expertise in the finance and accounting domain. At Crow Oman, he specializes in IFRS subject matter expert, leading and overseeing the implementation of various IFRS standards for clients across different industries. He has personally completed 100 implementation assignment on IFRS 9, 15, and 16. In addition to this extensive implementation experience, Mr. James Ravi is well versed in providing training and guidance on both IFRS and US GAAP. His expertise extends to conducting training programs and assisting organization in the adoption and implementation of these accounting standards. With this brief introduction, now may I request CIFRSs to welcome speaker of the evening with a flower of bouquet. CIFRSs, please.
Good evening. It's my privilege to be here this evening, and I would like to thank Chairman CA Jim Joseph and the other members of the management committee of the Muscat chapters of ICAI. And thank you very much for coming this evening. We are going to have a time of spending on some of the changes that's come up in IFRS effective 1/1/2023, and the other two areas which is very much catching up in the market and which many of the preparers of the financial statements are not much aware of. So I'd like to touch upon that as well. I want to make it as simple and practical as possible, not to go into the pedantic IFRS paragraphs. So any of you, if you have any questions, please keep it till the end of the session. We will have a time of question and answer as well, depending on the time availability and our dinner. Okay, great. So this topic is we were discussing and we thought what next in IFRS. As we have seen in the past one decade, I can say, since 2013. In the year 2013, a pack of 5 standards came up. IFRS 9, it got postponed, of course. In the beginning, it was also there. 11, 12, 13, and IFRS 10 also. For 10, 11, 12, 13 came together in 2013. Since then, there was no respite for the financial world or the accounting world as far as IFRS is concerned, because we immediately got IFRS 9 knocking at the door. Then it got delayed by a couple of years. Then effective January 1/1/18, we have IFRS 15 and 9 came together. We all had, I would say, a challenging time with implementing 15 and 9. And then immediately on 1/1/19, we had IFRS 16 coming up back to back. So that also had quite a lot of learning experience. And this year, I can say after 19, we had, of course, 2 years of COVID. IFRS 17, which was supposed to be effective from 1st January 21, got postponed because of COVID, and it became effective in 1st of January 23 onwards. For today's session, we'll cover IFRS 17 a little bit. You may be wondering, well, IFRS 7, as far as I understand it, is applicable only to insurance companies. Why should we bother about it? But I would like to tell you that, please make no mistake, it does cover other entities also. So that's the area which will be sort of an eye-opening for some of you here. So we will cover that as well. So today's agenda is going to be covering 3 areas. One is the IFRS standards and amendments newly effective from 2023, and the global economic trends and the geopolitical events and how that affects our financial statements. As financial statements preparers, how you must be aware of what's happening globally and how you must incorporate them as a disclosure or as a presentation in your financial statement. This is a new area. For the preparation of financial statement doesn't end with IFRS. Now the new areas are opening up. Yeah, so that's one area which we need to cover. We'll cover with some practical examples. And the last area, but not the least, is the sustainability standards, which is knocking at the door, which Oman is a little bit lagging behind, but though central bank has initiated it for the banks, that's going to come very soon. All of us will be impacted by that. If not made as a mandatory requirement, it will be a requirement in the supply chain of entities. Because if you are an entity, if you want to apply for a government contract or want to supply something to a reputed entity, they may require that. Are you complying with sustainability standards? Are you making sustainability report? So that's another area which is coming up. So with that, I can also say that as far as IFRS is concerned, IFRS 17 is almost the end of all the major standards have been implemented. For here onwards, what's going to happen in IFRS is going to be mostly the tweaking of the existing standards. There is nothing in the horizon as far as new standards are concerned. So that's the good news for you and for me, isn't it? For there's nothing great news thing is coming, but a lot of tweaking is happening. IFRS being a dynamic standard which is always coping up with what's happening in the business world, they have to keep themselves updated, and that's what's going to happen, and that's happening. So we'll touch upon that as well. For quite a dense session, but I'll make it as simple and as interesting as possible with your cooperation. Well, what's new in IFRS in 2023? There are basically four things going to be new. The major one is going to be IFRS 17. So IFRS 17, the title of the standard is Insurance Contracts. It's not insurance companies, it's insurance contracts. For any entity which is issuing an insurance contract will be impacted by or will be required to follow IFRS 17 for those contracts, for accounting of those contracts. And the way the term insurance is defined, insurance contract is defined, is quite vague, and it almost includes so many contracts which are not insurance contracts. So that is where IFRS 17 is applicable to non-insurance insurers also. So that may be a new area for you, for some of you, therefore we'll cover that in depth. And then it also going to include today, we are going to touch upon the changes that came in IAS 8, accounting standards, estimates, and errors, and IAS 1, and the IFRS practice statement 2, which has come up recently, and IAS 12, deferred taxes. For income taxes is the title of the standard. So what are the changes that's come up in IAS 12 also? So we will cover basically these four areas today. A brief history of IFRS 7. When IFRS became quite popular post the Norwalk agreement that happened between US GAAP standard setters, that is FASB and IASB, IFRS started, the IASB board started looking at all the standards and coming up with new standard wherever is required. From the year 2004 onwards, the exercise started. And when they started looking at the insurance industry, at that time they found that insurance industry have a very diverse way of accounting and presenting their insurance income and liabilities. Now, insurance industry is having very complex accounting as it involves actuarial valuation also. And the two areas are known as the incurred but not reported. Okay, and that one and the liabilities which are for the remaining period of the insurance contract. So these were complex areas. There were diverse practices followed. For IASB didn't want to rock the boat at that time by bringing in something new. They told that currently we will bring a standard which will be called IFRS 4, insurance contracts. That standard will almost like whatever you're doing, please continue doing. That's what IFRS 4 said. No need to change anything. Okay, that was a big relief at the time to insurers. IFRS 4 didn't do much, they were following whatever they wanted to do. And it took, because the IASB started at the time, the priority is not insurance sector at the time. All the other standards are waiting, and globally making a convergence of all the national standards with a global single set of standards was a major task for them. For G20, at that time it was G7, they were pushing them, and it was on a speedy way they were releasing the standards one after the other since 2004. Now, one more thing happened. Insurance companies were given a relief because there are a lot of common areas between IFRS 17 and IFRS 9 financial instruments. For insurance companies were told that if you are not implementing IFRS 17, you need not implement IFRS 9 now. At the time, IFRS 17 was not there. Therefore, they told that under IFRS 4, you have the freedom that you need not implement IFRS 9. For insurance companies, most of the companies, I would say almost 80-90% of the companies didn't want to go for IFRS 9 until now. For their financial statements were prepared not in accordance with IFRS 9, but with the old financial instrument standards like IAS 32 and IAS 39, and of course disclosures for under IFRS 7. For these three standards were there. Even today they are almost in a coma stage because IFRS 7 is quite strong, but 32 is there, but 39 is almost dead, as you know, because IAS 39 has been replaced by IFRS 9. For 39 is there only for the macro hedge accounting purpose, which is mostly done by banking and financial institutions. For the major standard today for financial instruments is IFRS 9, classification and measurement, and IAS 32, which is financial statements presentation, financial instruments presentation, and IFRS 7, which is financial instruments disclosure. For insurance company had a gala time for the past 5-6 years by not following IFRS 9. Now, IFRS 17 made it mandatory that when you adopt IFRS 17, you must adopt together with IFRS 9. So all the insurance companies are having a very challenging time this year, especially in Oman. The CBO came out with, the CMA came out with a circular, and they were closely following the implementation of IFRS 17 by the insurance industry. Is there anyone here from insurance company today? Okay. For you may be well concurring with me what I am saying. If I am going somewhere, making some factual errors, please correct me, because what's latest, I'm not very well aware what CMA has done with the insurance. I know that all of you have done phase 2 of implementation, and the first quarter financial statements which have been published have a paragraph or a huge disclosure on IFRS 17 by almost all the insurance companies. Am I right, sir? Yeah. And together with this, you are also having a tough time implementing IFRS 9. Yeah, so it's a double whammy. And they've done quite well, and CMA is not going to have any concession on that. By end of 2023, all the insurance companies will be complying with both IFRS 17 and IFRS 9. That's the status. Now, insurance entities in Oman and regulatory role by CMA is quite important. And also, IFRS 17 specially excludes certain contracts from its scope. It's very important for us to know which are the exclusions given by IFRS 17, so that we will know whether, if you are working for a manufacturing company or a contracting company, whether you fall under that exclusion. If you don't fall under that exclusion, then some of your contracts, which may not be called insurance contracts, you may have to apply IFRS 17. Okay, that's a very critical area. For other contracts and arrangements that may fall under IFRS 17, though they are not called insurance contracts, like warranties, financial guarantees. We'll see them in the coming slides. For what's the definition of insurance contracts under IFRS 17? For insurance contract, it's a contract under which one party, for when it's a contract, you must have two parties. For one party is the insurer, the one who issues the insurance policy, and accepts, what he does, he accepts a significant risk from another party, who is called the policy holder, by agreeing to compensate the policy holder for uncertain future event. So the critical terms in this definition is the insurer, the insurance risk, the policy holder, and the uncertain future event. For the definition is made so elaborate, it includes so many other contracts which are not insurance contract also. So that is where we are getting caught. And IFRS 17 gave very broad and very complicated models for measuring the revenue and almost all items in the financial statements, the P&L as well as the balance sheet. And those three different models were given. It's not a free choice that you can choose whichever you want. If your contracts fulfill certain conditions, then you have to go for the first one, general measurement approach. That is the most complicated approach because it incorporates the actuarial valuation and the IBNR, that is incurred but not reported, and the LIC, the liability for remaining period. All that will be covered in that. So it's a very complex model. It involves not only the accountant's role, it does include a lot of role, and many parts of that have to be given by the actuaries, and based on that, as preparers have to prepare the entries. And a little slightly less complex model was a premium allocation model, which almost follows the accrual concept of accounting. For it says if your premium is for 10 years and you have completed 1 year, then 1/10 of that can be recognized as revenue this year, and the remaining 9/10 has to be taken as a liability in your book, which is quite logical and commonly done. And the third one is a variable fee approach, and that's also very slightly less complicated. As non-insurance company preparers, you need not be bothered much deep about these methods. I don't want to go deep into that. In fact, if you want to take on IFRS session, we can have one full day session on that. So it's not required, and we're not going to do that now. What is required is you have to know what is excluded from IFRS 17. And you have to see whether you or some of the contracts in which you are involved that fall under this scope exclusion. For paragraph 7 of IFRS 17 excludes these 7 types of contract. It makes a specific, these are almost copied with a little bit of simple English. For the first one is a warranty is provided for the manufacturer, dealer or retailer in connection with sale of its goods or services to a customer. As you all know, when you go to buy a car or you go to buy a mobile phone or even any other electronic equipment, you get almost 1 year contract, 1 year warranty for mobile phones and electronics. For cars, you get 3 years or 5 years, depending on the manufacturer. Sometimes they also offer extended warranty that you have to pay for additionally. 2 more years you can pay. For these type of warranties, when you look at the definition of insurance contract, these warranties will fall under those contracts because it's covering, there are 2 parties, it's covering the future uncertain event and the risk. So, if the exclusion is not there, all the warranties will have to be accounted under IFRS 17. So thank God for this exclusion. But it doesn't stop there. There are some warranties which will fall under IFRS 17, which we'll see in the next slide. The next is the employer's assets and liabilities from employer's benefit plan. As you know very well, there are 2 types of plans available, defined benefit plan, defined contribution plan under IAS 19, employee benefits. And in Oman, we mostly follow defined contribution plan, especially for Omani nationals when you have the pension authority is there and you contribute the money based on the number of employees you have. For your liability is over because it's a defined contribution plan. For what is defined is a contribution to be made by the employer on behalf of the employee's pension. Whereas there is another type of plan which is known as a defined benefit plan. There, the liability of the employer doesn't stop with just contributing it. So how does pension work? In pension, we collect a pool of funds and we create pension assets. And from that assets, we pay out the pension every month to the retired employees. For the pension fund has a pension asset and a pension liability. There could be times that these liabilities and assets may not be equal, because assets are affected by so much of market fluctuation, liability is affected by both increase and decrease by the new members added, the changes in the amount, and all such things. If that's happening, if tomorrow the assets fall much less than the liability, who is going to bear the brunt? For under defined contribution plan, the employer can wash off, as happens in Oman, because it's a defined contribution plan, the pension authority will take care. Thank God the employers do not bother about it. But under defined benefit plan, which is applicable in most of the advanced countries like US, Europe, Canada, all, even in India, the employer becomes liable for the deficit of the plan assets over the plan liabilities. So that is where it comes. For it looks like a future uncertain event which is creating an insurance contract. Since it is already covered by IFRS, IAS 719, IFRS 17 has given an exemption from the scope. It says that you need not apply IFRS 17 for that. The third one is a contractual obligation contingent to the future use of, the right of use, a right to use. As soon as I say right to use, you should all remember that it's talking about leases under IFRS 16. For under IFRS 16, you create a contractual obligation. That obligation, again, though it is having the future obligation that you are supposed to give, if a lease is extending more than 1 year, of course, long-term leases are very common. And that liability will also be very much falling under the definition of this insurance contract, but for this exclusion. The next is residual value guarantees. Yeah, this is another area where if you are taking say, a JCB or a crane on a long-term lease, for the lessee has to give residual value guarantee that when I return the asset back to the lessor at the end of the lease period, the asset will have at least this much value. That's mainly to prevent abuse of the assets by the lessee. Yeah? Now that also will very much look like an insurance contract under the definition. Therefore, it needs to be excluded, as IFRS 16 takes care of it. For IFRS 17 need not bother about it. And certain financial guarantees, yeah, an entity giving a guarantee on behalf of the intercompanies, parent company giving for subsidiary and vice versa, guarantees given for associates. All these are exempted from IFRS 17, though they very much will fall under the definition of insurance contract if this exclusion is not there. So they removed and they are, IFRS 9 applies to them. And the contingent consideration payable or receivable in a business combination. That's another very interesting area. You all remember some 8 years back, WhatsApp was taken over by Facebook, Mark Zuckerberg. And at the time, anyone remembers how much was the purchase consideration? $19 billion. So at the time, WhatsApp was not having so many features what it has today. So that guy thought about it and he took over WhatsApp for $19 billion. The book value of the company was hardly 300 million because they had a small office in Bay Area in San Francisco. That's it, some few servers and some few employees. But Mark Zuckerberg saw that value of the company at the time and he took over. And when he took over, there were a lot of, he paid immediately, some in cash out of the 19 billion and some he gave Facebook shares. At the time it was not called Meta, it was called Facebook. So he gave that shares. And remaining he told that's as a contingent consideration. If WhatsApp does well in future, then on a particular calculation he will be giving a particular amount, the remaining of the 19 billion in installments to them. That is the exactly called contingent consideration because it is not firm, it's contingent upon the future growth of that company. For it is given mainly to motivate the employees and the management to perform. Because generally what happens in mergers and acquisitions, post-merger and acquisition, there used to be a big drop in the performance of the company. For the acquirer wants to take care of that it doesn't happen, so that the new shareholders will not have any loss on that. So that's why they bring in this contingent contract consideration. So that will very much look like a future liability. Now that is also falling under IFRS 3, and that is excluded here because if it's not excluded, it may fall under the definition of insurance contracts under IFRS 17. And finally, the insurance contract in which the entity is a policy holder. Thank God for that, because you are, when you take a policy, one of the parties to the contract, right? If this exclusion is not there, you are entering into insurance contract. As a result, for the policies which you take for your own assets, your own employees, your own business, you will have to apply IFRS 17. For, as a policy holder, we are excluded. What a relief. Yeah. For, it's not easy to adopt IFRS 17. Please, our friends will tell you how difficult the time they are facing, moving from the old to the new IFRS 17. For these are the exclusions. For when we look at the exclusions, we are happy, okay, that's good, we are not there. For we are also excluded, even though I'm working for a manufacturing company, even though my entity gives a lot of financial guarantees, I won't be falling under that. Wait a minute. What this says, IFRS 17 for non-insurers. There are some specific contracts, even though scope excludes them, if they don't fulfill the conditions, they will fall under the IFRS 17 trap. Okay. They are number one, product warranties provided by a manufacturer, retailer or dealer in connection with the sale of its product, not together with the sale, but after the sale is over, if they are giving, after 6 months, the customer is coming and asking, I didn't take the warranty, extended warranty which you gave at the time, now I want to take that, can I pay additional money and take it? Many companies give that. In fact, many entities, they create a separate subsidiary as, you can say, vehicle, a separate vehicle, and then they make that company give the insurance contract or the warranty contract, extended warranty contract to the customer. For in that scenario, it will be slightly different. For those contracts, you must apply IFRS 17. Next is a fixed fee service contract. Any contract which you do, like maintenance contract, anything for more than 1 year, and then you have a fixed fee there, you may fall under the definition of IFRS 17. And a roadside service contract, like the AAA, Arabian Automobile Association, where they provide this contract, because this very much the contract fulfills the definition of IFRS 17. So even though you are not an insurance entity, you may have to follow IFRS 17 for them. And certain financial guarantees and performance guarantees, like which were otherwise covered under IFRS 37, provisions, contingent liabilities, contingent assets, IFRS 9, financial instruments, and IFRS 17, insurance contracts. Credit cards and other payment arrangements may fall under IFRS 17 if certain conditions are fulfilled. We don't have time to go through each one of them in detail. Let me give one simple example to understand the concept. Let's look at this example. IFRS 17 for non-insurance. A consumer electronics company provides to its customer at the time of sale. That's the most important point of that example. At the time of sale. Because that's what the exception para 7a says. At the time of sale, if you are giving a warranty, then you are excluded. 3-year free of charge warranty to cover repairs due to manufacturing defects. In addition, for a fixed price, the customer can purchase a further 2-year extended warranty repair cover. At that time, if he takes it, yes, it is excluded. Sometimes the extended warranty is given by a subsidiary, which is by a special purpose vehicle, special purpose entities. Question. Is either of these two contracts, that's the main warranty and the extended warranty, fall within the scope of IFRS 17? That's the question. What's the answer? No. No. Both the warranty and the extended warranty provide protection to the customer against uncertain future events. That's the very crux of the insurance contract. For it covers uncertain future event, but since it is given together with the sales or at the time of sale, it is excluded by para 7a. Therefore, it need not apply IFRS 17. So, however, since both the type of warranty are available at the time of sale, they will meet the scope exclusion under IFRS, para 7a of IFRS 17, and the insurer need not account under IFRS 17. Now, let us tweak the same example a little bit. Is everyone with me? Yeah. For here, we are slightly tweaking the contract. Would the answer be different if the extended warranty contract is provided at a later date and the terms of the original sale did not provide for the future purchase of the warranty at a fixed price? Then the scenario changes, because it is not at the time of making a sale. For it's a standalone contract. As a result, it very well falls under IFRS 17. The issuer has to account it for under IFRS 17. Yeah? Yes, if the extended warranty is provided at a later stage and not in conjunction with the sale, that's the point. It will not meet the scope exclusion because it is not in connection with the sale. If so, the entity shall apply IFRS. Now, when it comes, you may be working for a retail outlet or a manufacturer who may be providing a lot of these type of warranties to your clients. For now, we are in the month of June. By the end of the year, you have to be very careful what type of warranty is it. Does it fall under IFRS 17 exclusion or not? If it is not falling under that, your auditors may force you to apply IFRS 17 for that. Yeah. Logically speaking, we must follow that. And when we follow which model to adopt, the option is you can choose the least complicated model, either the premium allocation model, which will be almost like accrual accounting model. So that's one relief. Otherwise, this is one scary thing which is there. You must be geared up if you have any of these contracts, which is not. I would like to share the slides also with the chapter, and they would like to share. They may share it with you. So you can go through it later on. Okay, for that's about IFRS 17. For whether you are an insurer or a non-insurer, you do get a hit by IFRS 17. Well, what are the other changes that's coming up in this year? For the other changes is IAS 8 accounting policies, changes in accounting estimates, and here this is one of the very crucial standards which is foundation of IFRS, we can say. IFRS, IAS 1, IAS 8, IAS 10, IAS 37, these are all the foundational standards which will be there, which were there, they will be there. IAS 8 specifically makes a distinction between what is an accounting policy and what is an accounting estimate. You all know that very well. I don't want to go deep into that. And it does define what's an accounting policy, but till December 31st, 2022, it did not define what is an accounting estimate. For accounting policy, you know very well, if you're having an investment property, you have option to follow either cost model or fair value model. If you have property, plant and equipment under IAS 16 or intangible assets under IAS 38, you have the option to follow either cost model or revaluation model. And you have so many options here and there in accounting policy matters. And accounting policies, according to IAS 8, once you adopt a particular model, you are supposed to consistently follow year after year. So if at all you want to change an accounting policy, for example, in IAS 40 investment property, you want to move away from cost model to fair value model or vice versa, then you must fulfill certain conditions. One of the very important conditions is the new standard and the new policy should be more relevant and reliable than the old one. How to prove it? That's between you and the auditor. Okay, but very important aspect of change in accounting policy is you are supposed to do the accounting policy change with a retrospective effect. The definition of retrospective effect is as if this new policy has been followed from the beginning of the entity. For if your entity is more than 20 years old, you have to go back and see that. For very complex headache it is. And what they do is generally they adjust it in the retained earnings, you know that, of the earliest period presented. That is accounting policy. But when it comes to accounting estimates, the standard says estimates are to be reviewed every year. Every year you need to review it. What are estimates? Estimates are basically, good examples is you can say provision for doubtful debts, which is now known as highly technical ECL, and provision for warranties, provision for employee benefits. These are all estimates for which you make based on the future facts taken into account with your judgment. For estimates have to be reviewed every year. Having said this much, IAS 8 did not define what is the exact definition of estimates. For now, they have come out with that. Why they did that this year? Because there are a lot of confusion between a particular situation, whether it is an accounting estimate or an accounting policy. Sometimes the inputs used in making an accounting policy looks like an estimate. They are, of course, estimate. When they change that estimate, will it be treated as a change in accounting policy or an accounting estimate? So there is a lot of confusion going on around the world in this area. We'll see one or two examples. We will make it clear. As a result, IFRS start thinking that it's better to come out with a clear-cut guidance that how to deal with an estimate and what exactly is the difference between estimate and a policy, so that there won't be any confusion in the preparer's mind. See, the overall objective of IFRS is this: make a single, consistent standard followed by the preparers, so that their financial statements will be easily understandable and comparable by the stakeholders. So with that objective, they did bring in a nice definition. The definition goes like this: accounting estimates are defined as monetary amounts in financial statements that are subject to measurement uncertainty. For the most important aspect of the definition is measurement uncertainty. So you have measurement uncertainty. It is not certain. Provision for bad debts, you don't know how much it's going to be. Provision for warranty, you don't know how much it's going to be. With your past experience, you make an estimate which is rational, reliable, faithfully done, consistent, all that. Then the auditor is happy and you are happy. Life goes on. So that's how it is defined. Now the definition has come. This amendment also clarifies what changes in accounting estimates are and how these differ from the changes in accounting policy, which were not there earlier. Now they brought it out. For example, if an entity which follows a fair value model in IAS 40 has elected to change its valuation technique, make no mistake, it's not changing the policy, it's just changing the valuation technique. Most of the entities in Oman we have seen, even among our clients, investment property is one of the items always there in the balance sheet. Yeah, because we would like to, that's one of the investment avenues for the entity, which may be a manufacturing entity or which may be completely unrelated to that. You know, investment property, IAS 40, I need not go deep into that. So we follow different models for fair value. For fair value model, when you follow in IAS 40, strictly speaking, every year you are supposed to do the valuation. The standard doesn't say whether you have to do it internally or externally, but the auditors will be happy if you do it externally. For you can do it internally also. But there you have to apply IFRS 13, which is the fair value standard, fair value measurement. IFRS 13 gives you three different approaches for measuring the fair value. They are the income approach, the market approach, and the cost approach. For when you apply that and evaluate and value your investment property under IAS 40, you can take any one of the approaches and do the measurement. And as an auditor, they will certainly look at it, and as you have to be consistent with that. Sometimes, instead of doing a market approach, which is based on the demand and supply, you can move away from that and go for an income approach. Because if it was a piece of land which was lying vacant for a long time, so you applied market approach and valued it. But now somebody has come to take that as a warehouse and they want to take it and you are given it on lease. Okay? And which is not part of your business. Therefore, still continues to be an investment property. Now the income is generated from that. For it, you believe that it's better to apply income approach than market approach, because by that I can show some right fair value presentation in the financial statements. Now this is a change in the approach. This is not a change in policy. This was not very clear earlier. For now, after this, it made very clear that this is not to be treated as a change in policy, it will be treated as a change in estimate, because some of the entities globally, in some remote places, they were treating this as a change in accounting policy. So that's what happened. Now we understand what is an estimate and what is an estimate for input into accounting policy. For if it is an input into accounting policy, if it is changed, that doesn't mean that the policy is changed. It still is an estimate change. So that's the explanation given. this under this new amendment. Therefore, IAS 8 changes two things. Number one, it defines what's an estimate. Number two, it makes a distinction between what is an estimate, what is an accounting policy. So there's a good guidance. It helps a lot. There's another example how you go for share price volatility and option pricing model, which is not relevant in this part of the world. Okay. So we have seen IFRS 17, IAS 8, and the third one is IAS 1. IAS 1 is, they made a big change because if you remember in all of our financial statement, note number 2 or note number 3 will be significant accounting policies. Now they removed the word significant because the word significant is used extensively in the IFRS material, but nowhere it is defined. So that's a very convenient thing to do. Now the word significant has been replaced by the word material. So you are not going to call any more significant account policy. You are going to call material accounting policies from 1/1/2023. Well, IFRS is not very stringent about terminologies used. Even if you continue using significant, it's not going to be a false. But the right way is to use the word material accounting policy. Why it becomes important is, many times even as an auditor, when we look at the financial statements of the companies, an entity just gives the significant accounting policies without any proper thinking and application of mind. Most of the time, the significant accounting policies are copied and pasted from the standards, or sometimes copied and pasted from the other entities. Entities who do not have any investment property have 3 paragraphs of accounting policy, significant accounting policy, and IAS 40. Why do you have it? And the finance manager says, sir, this has been going on for 20 years and we don't want to make any change because if I change, my board will ask so many questions. So I don't want to face that. I don't want to make a change. It's a typical problem faced by we finance managers. For as an auditor, you suggest, then we will change. Sorry, we are not supposed to suggest anything. We are supposed to point out where the audit, where the accounting were weak. So that's where we stand. For significant accounting policies become many a times, it's just filling up the pages, just a padding exercise. It doesn't serve any purpose. Now under this new IAS 1 changes, the material accounting policy has to be very judicially chosen and presented in your financial statement. And they give, to help the preparers, they come out with a new document called practice statement. How many of you know that? IFRS practice statement. You know, IFRS body of knowledge consists of 5 areas, which is the IAS, IFRS, IFRICs, SICs, and the conceptual framework. This is what is there in the red book, blue book, green book, all the books. But this is something outside the 5 of them. There were 2 practice statements issued in the past 10 years by IFRS, IASB board. The main important difference between the 5 and the 2 is, the 5 are mandatory. If you say you follow IFRS, you follow every word in that 5 areas of knowledge or areas of material. But these practice statements are given for guidance purpose, therefore they are non-mandatory things. If you don't want to follow, you can do what you want, but it must be in compliance with the other 5. So that is that's why even this practice statement is not printed along with the red book, because it is not a mandatorily required area. Now they created a new PS2. Okay. So it's not PlayStation 2, it's practice statement 2. Otherwise even PS2, nowadays PS2 is standing for Ponniyin Selvan. How many of you are here? For it has nothing to do with these things, it's PS2, it's a practice statement 2. So what it says is, it gives a 4-step model in selecting what is a significant, which is a material accounting policy. So it says you need to identify, you need to analyze, you need to organize, and you need to review these accounting policies. So as a preparer of a financial statement, you have to see these accounting policies, whether they are worth to be presented in my financial statements as note number 2 or 3 in the disclosures. So that's how important it is. So be bold enough to remove all the junk which is there. Make the financial statements more relevant and useful to the preparers. Just don't copy. It is going on for 20 years. I don't want to change. Please don't do that. IFRS doesn't accept that. Well, that's the change which is coming in IAS 2. So we covered 17, we covered IAS 8, and we covered IAS 1. Not big change that's going to affect us, but it's called material change. The material replaces significant. Okay, here we can see one illustrative example. What is a practice statement? As we have seen, you can get, it's freely available on the internet, and it's around some 30 pages. You can, if you are bored of watching TV, IPL is also over, you can read it when you don't get sleep. I tell you, that material is a great medicine for insomnia. If you are suffering from sleeplessness, open it and read one paragraph. I tell you, you will fall asleep. So, and it gives a four-step model, and it also provides some guidance on how to make the materiality judgment in specific circumstances, namely how to make material judgment about prior period information when you are presenting in the finance statements, errors, covenants, in the context of interim reporting. That's become very important. So it helps a lot in applying IAS 34. Well, these are the three changes, and comes the fourth change, which is income taxes and IAS 12. We all know income taxes, and just before we understand this, what's changing here, you need to know a little bit of the background of IAS 12 and what does that standard say. So wherever you have in your financial statements any item for which the carrying amount is different than the tax base, you will land up with a difference. A difference creates a difference. So we know very well what's the carrying amount. Carrying amount is, for oldies like me, it's a net book value. So that is what the figure at which you carry in your books. And tax base is the amount which is given for that particular item under the tax laws. So if they are the same, then you don't have any issue. But if they are different, then you have an issue with IAS 12. Because that difference could be of two types: permanent difference or temporary difference. If it's what's a permanent difference? For example, if you are buying tax exempted bonds, that means the interest revenue from that is exempted from tax. Now that will certainly create a difference, because that will have a carrying amount, but that will not have a tax base because it's exempted. Now that will never reverse, because that's once given, it's gone. Therefore that's called permanent difference. So permanent differences are falling outside the scope of IAS 12. Now the problem arises only in temporary differences. A good example of a temporary difference is if you are buying a pollution control equipment, and according to your straight line method of depreciation, you take some 1 million reals. But income tax, government encourages this type of pollution control equipment. So income tax gives you 25% depreciation in the first year. That creates a big difference in the depreciation amount. Now that is a temporary difference. So all temporary differences could be broadly of two types. One is called the taxable temporary difference, or it could be a deductible temporary difference. A taxable temporary difference is a difference which is going to create a future problem for you. Because this year you got a tax benefit, tax guys will not leave us. Even if I die and go to the grave, they will come and dig me out and take the money from my pocket, okay, if I have. So they are not going to leave us. For temporary taxable temporary differences, temporary taxable differences are differences which will create a deferred tax liability. Because this year you are having a benefit of paying less tax by taking the 25% depreciation under the tax returns, even though in your accounting books you are claiming only 10% depreciation under straight line method. You have to pay in future. How? If the asset is sold, the depreciated amount will be net book value versus the sale amount is going to be the capital gain or loss. That will be taxed at the time. You got it. So IAS 12 brings in, so this creates a liability which is not accounted if IAS 12 is not applied. So that is why they want you to account a DTA, deferred tax asset and deferred tax liability. So if you are going to get a future benefit, That will be called deductible deductible temporary difference. That will result in deferred tax asset. So that's the background of it. Now, there are two areas which recently come up. One of them recently, one of them quite old. For example, leases. When leases standard came in IFRS, in the form of IFRS 16, what we are doing under IFRS 16 is a lease asset. It's not my own asset. So I pay the lease rental. That's what factually happening. But the standard requires me to recognize a lease asset and a lease liability and book both of them on my balance sheet. So you are creating an asset and liability in the first year of equal amount. Mostly it will be equal. In that scenario, one is going to create a deferred tax asset and the other one is going to create a deferred tax liability. Therefore, many entities thought that, why should I make asset and a liability of equal amount? I will not book any deferred tax. I will not recognize any deferred tax asset or liability for leased assets, for my right of use asset and the lease liability in the balance sheet. There was no clarity. As a result, it was going on. But some entities meticulously created deferred tax asset and liability for most of our clients. We make it mandatory to make it because that's what the standard requires. And they made it both the deferred tax asset and deferred tax liability. See, the argument that in the first year, what is the use of creating one on the asset side and the one on the liability side? Both are notional. And what is the use when both are equal? The point is, in the first year it may be equal, but as you go forward, the right of use asset will depreciate at a different rate. The lease liability will get reduced at a different rate. For later period, you may have a difference. But at that time, if you don't recognize the DTA and the DTL, your balance sheet is not fairly presented. That is what plugged by this amendment. So what they did is, they brought in, one area is lease, the other area is decommissioning expenses, liability. How many of you remember that? It's under IAS 16, property, plant and equipment. So if you are putting up a plant which is going to have a toxic impact on the environment, at the day you put the plant, you are supposed to recognize the future when you dismantle the plant after 20 years or 25 years. What will be my liability to dismantle the plant and decommission the plant at that time? The standard says, IAS 16, that now it is applicable to most of the oil companies. It applies to when you have even offshore, onshore drilling. They are supposed to do that. I don't know how many of them do that, but as auditors, we insist that they must do it. So you are supposed to recognize the future liability today by computing the present value of the liability. And you have to pass an entry. Now you have only a liability, you don't have contra asset. So what will you do? So you create an asset. You debit the particular property against which you created this decommissioning liability. And that value will be getting depreciated over the life. And the lease liability will get increased every year because of the unwinding of the interest. So you will have a dual impact in the P&L. Depreciation will be there. And the notional liability of unwinding of the present value of the interest, present value of the decommission liability from now until the 20 years later will happen. Now again, these two are like right of use asset on the lease liability. They are notional. They are not real. For many entities, didn't do deferred tax impact on these two assets, these two items. That is what plugged by IAS 12. So what IAS 12 has done is, they brought in this point that it is mandatory. If you have a decommissioning liability, you must have deferred tax impact on them, as you have done in the case of lease. So that's a change this year. So if you're already doing it, well and good. If you don't do it, you may have to do it now. And the point is, if you do it now, you're supposed to do it with a retrospective effect. So you need to compute that, because the asset would have been leased 3-4 years back, and the lease standard came 1/1/2019. So you have to rework back and then do it now. Now the same thing applies to decommissioning expenses also, liability also. So that's how it is. This standard also comes into effect at 1/1/23. and with earlier adoption permitted, and to my knowledge, nobody did it. Well, with that, we cover the changes that's going to come. Therefore, what we take away this evening mainly is these 4 changes. One is IFRS 17, insurance contracts, and number 2, IAS 8, that where estimates are defined and the distinction between estimates and change in accounting policies are very clearly identified. And IAS 1, where the term material is replacing the term significant. And IAS 12, where you are compelled to make DTA and DTL for leases and decommissioning expenses. That's a simple way I put it, so that it'll be easy for you to remember what you have at the end of the day. Great. So with this, we cover the first area. As I told, the 3 areas are going to be covered. The second area is going to be, as financial preparers of financial statement. As preparers of financial statement, thank you. We are not just to follow the IFRS and then say that I followed all the IFRS and that's it, I'm done with that. No. Nowadays things are changing, that the geopolitical events, the changes in the economy is happening are very much affected. Things happen in US, Oman entities are getting affected. So we are going to see some examples. So this has become another area, a big challenge for the preparers of financial statement. I'd like to give a list of few items which today happening, and even it was there in 2022 year end, and many entities have incorporated a disclosure at least in their financial statements on these matters. Okay, so if you think about it, what are the big changes happening? Today, ongoing war in Ukraine is one of the big challenges. I don't know how many of you are aware that it has affected the food chain logistics so much, because Ukraine was supposed to be the wheat basket of Europe. One of our clients in Oman, their 100% supply of wheat was taken from Ukraine until last year. Now that is completely cut off. So that created a big question of going concern also. Because wheat price have gone up, food price have gone up. I don't know how many of you were closely watching the Ukraine war. 2 days back, the big dam on the Dnieper River was demolished. That has created, completely wiped out the delta area of 300,000 square kilometers in the Crimea country. Because the river is having a delta there. And that is where around 30 to 40% of the sunflower is cultivated. Now, all the vegetable oil entities who depend on sunflower oil, and even their competitors or their substitutes like palm oil, their prices are skyrocketing as we speak today. So as a commodity dealer or commodity trader or one who uses this, you will have to know if your entity is using heavily these oils as your raw material, your cost is going to go up. So you are supposed to make at least a disclosure to the stakeholders. For the next, the judgment, estimates, uncertainty is always there. Impairment of non-financial assets, that's what we call an ECL. The discount rates, which is based on interest rate, that we'll have a separate slide. And even after the reporting period, we call subsequent events, where IAS 10 covers that. Assessment of control, joint control, where if you have a subsidiary or an associate in Ukraine or in some other war zone where you can't have proper data, how are you going to do your closing of those entities? That's a big challenge. And inflation, another big area. Globally, the interest rate in the past 1 year is going up like anything. US continually increase the rate. It's almost now touching 4%, 4.5%, which used to be 0.5 or 0.1 3 years back. Huge increase in the inflation, in the interest rate, mainly as a countermeasure for inflation. That's what the central bank does. When the inflation is going up, they increase the interest rate as one of their monetary policies to control the money supply. That's affecting our financial statements. And of course, financial instruments always a challenging area, and the disclosures you need to make. For all these global events like ongoing war in Ukraine, your rising energy prices, Oil prices are going like a roller coaster ride, goes up to 130, came down to 70. And supply shortages, another big area, because that may affect, if that's the only supplier you have, it raises a going concern question. Inflation, interest rates, all these are how they affect your financial statements. As preparers, you are required to do. Don't ask me where does it say in the IFRS they have to do. That's where the regulators come into play. Okay, therefore the local regulators are bringing in these type of circulars, and even on interest rate, already central bank has given 2-3 circulars to the banks, how we are going to do that. That is going to affect your impact. Where all your interest rate is getting affected, your interest rate will affect this many areas in your financial statement. When I say interest rate, I'm talking about the market rate, yeah? The benchmark rate given by the central banks. For your impairment of assets, your value and use is going to be affected by that, because that's nothing but the future cash flow discounted at the interest rate, the weighted average cost of capital. Your fair value of financial instruments, they are certainly affected by interest rate. Fair value of, like your amortized cost is purely based on interest rate. Fair value of investment property, because when interest rate goes up, every year asset value, intrinsic value of the assets come down. Okay. For fair value of biological asset, again, interest rate is affecting them. Leases, long service lease, options, IFRS 2, which it doesn't apply much here, and other standards also getting affected. For interest rate, when it is affected or changed by the central bank significantly, if it is just 250 basis points, then you don't mind that. Otherwise, your valuation has to incorporate the change in the interest rate. So as a preparer of financial statement, you must note that point. For it happened practically in our case. I'm talking about last year, in February 22, we were completing the audit of one of the major cattle feed supplies, manufacturing companies in Oman. And their 100% cattle feed, that is their wheat supply, comes from Ukraine. The year end is 31st December 2022, but the audit is going on now in the month of Feb. And the Ukraine war broke out, and we know that the supply is completely stopped. When that happened, it becomes a subsequent event. As an auditor, we are supposed to tell them that your future investors have to know what's going to be your plan, how you are going to deal with that. And the client agreed, and they made this note as a note number 42, subsequent event in their financial statement. It's a public, it's a SAOG entity, therefore it's available in the CMA website. Here they made very clear note on how the supply of their raw material is affected and how the company is going to manage this. For the last time, how the management and the board of directors are reviewing the situation very closely to investigate the future adverse impact. To mitigate the future adverse impact. So that's how the note is made. For the geopolitical events happening all over the world do have an impact on your financial statement. For as preparers, don't stop your work only with the IFRS application. Please have your eyes opened on these also, because it may be questioned. The borrowers, the lenders, the banks may ask you, the regulators may ask you if you come under regulatory realm. Or your board of directors and owners may ask you what you have done with this risk. Because if you remember, IFRS 7 talks about 3 risks which most of the entities do disclose in their financial statement. That is credit risk, liquidity risk, and market risk. Now that doesn't cover this type of geopolitical risk. So this is an additional risk which we may have to keep our eyes open as preparers to match up with that. Well, with that, we can, another big area is hyperinflationary accounting. As you know, there is a standard which nobody bothers, nobody knows also. Even the standard setters have forgotten. That's called IAS 29, hyperinflationary economies. Because at that time, in my knowledge, if I'm thinking correctly, in the past 10 years, there was only once this was triggered by Zimbabwe. Some 10 years back, Zimbabwe had a huge inflation. Even I still remember the media publishing, a lady is going in the morning with a load of currency notes and coming back in the evening with a loaf of bread. Well, that was inflation. So if it is a hyperinflationary economy, then you are supposed to apply IAS 29. Basically, it says you are not supposed to follow historical cost accounting in your financial statement. You are supposed to apply current cost method. It's a huge work, conversion we need to do based on the inflation and the index. Now, as we speak today, this around some 18 countries are already in the watch list, around 12 countries I think, starting from Argentina to Zimbabwe. And Haiti is a new one which is added, and Sri Lanka is in the watch list. Pakistan is not there because the definition of hyperinflation is not fulfilled there. Yeah, hyperinflation need to be almost 100% in the past 1 year. For watch list, we have around some another 6 or 8 entities. Now the point is, if you have any associate or subsidiary or joint venture with any of the entities which follow the currencies of these countries, even though they may not be there, if they follow the currencies of these countries, then IAS 29 will apply to that. So you cannot take the balance sheet in the historical cost basis. You will have to convert that into current cost basis as guided in IAS 29, and then you have to do your incorporating or do your consolidation. So that's again another area which we need to see. 1 year back there was nothing in this list except Zimbabwe. But today we have so many countries going into that. For global inflation is a very, very common thing today we have in the world. Well, with that we cover the global geopolitical area. The third area today we talked about is the sustainability reporting. And what is it? We hear that, we don't know what it is and how does it work. In fact, I was telling the chairman, and you will have to do this year at least 2-3 events on sustainability reporting. It's going to be, though in Oman is slightly laid back in catching up with that, but we know very well, all of a sudden they will come out and then say, okay, next year is going to be implemented, be ready for that. India doing, even UAE started doing it. Yeah. Many entities are doing on their own. Like even in Oman, like we have Sohar Aluminium, they have a huge sustainability reporting because they are the subsidiary of Rio Tinto, the major mining company in the world, or they are into aluminium also. Because the supply chain requirement or the need happens then. So basically when we talk about sustainability reporting, we talk about 4 different things as of now. It's a little complicated area. One is the ESG, that's where it started, environment, social and governance reporting. Yeah. Again, these are all private initiatives, not mandatorily required, except in some jurisdictions. Europe, Canada, Australia are already ahead of it. They are making mandatory, the regulators are making it mandatory in many industries. And TCFD, the Task Force for Climate-Related Financial Disclosure, that's almost universally applied today. Many entities are putting that type of a disclosure in their financial statements, climate-related financial disclosures. So how climate change is going to be affecting you. That's only a small part of the sustainability reporting. The 2 major standards which is coming up, one of them is already there for 25 years, is the ISSB, International Sustainability Standards Board. That is under IFRS organization. So IFRS now has both IASB making IFRS standards and ISSB making sustainability standards. Already 2 standards are released, IASB 1 and 2. So that's going to be an entity which follows IFRS may have to follow ISSB if at all they are compelled to do sustainability reporting, either by the country in which they are operating or the regulator under whom they are operating. The other one is the GRI. GRI is US based. So this is Global Reporting Initiative. GRI is quite old. GRI is having a journey of 25 years. Okay. So if you see, GRI started sometime in 1997. And today in 2021, many initiatives many industries are compelled to make in the US sustainability reporting. For in sustainability reporting also, as we have in accounting, financial reporting, two sets of standards parallelly going now. One is the IFRS, the other one is the US GAAP. Something is developing, that's what my guesswork, I see like that, in sustainability reporting also. For ISSB will be applicable to those who follow IFRS like you and I, and GRI will be applicable to those who follow US GAAP. It's going to be like that. As of now, it is not. But in the coming days, it's going to be like that. So if you are moving to US, you will have to know US GAAP and GRI standards. So currently, you have 4 sets of things happening. Very soon, they all will be converged and become one single set of standards which you will have to follow. Well, future is bright, and we hope for that. And with that, I would like to conclude my talk. Yes, yeah. So we can have some questions as a time permit.
Because sugar is diverted in ethanol production.
Yeah.
There are a lot of capacities added in India and other parts of the world.
South America, yeah.
So, it's not only war. Things are changing so fast that last year nobody would have thought that sugar prices will increase because of it.
Yes, PRS. Thank you for that. Yeah, it's true. That's what we are talking about. So if you are involved with any of your raw materials going to be sugar, certainly you should consider the increase in the cost that's going to happen in the coming years in your budgets, on your internal reports. Any questions? Yes, sir. Here the mic, please.
Hello. Sir, when you are talking about IFRS 17, you made a list of excluded contracts which is not covered under the insurance contract part. So in that I have 2 questions. The first one on the warranties by the manufacturers, dealers and retailers. What about the warranties by the contract companies where they do give for 1 year, 2 years, and also they will give warranty plus maintenance also.
Yeah.
Whether this will come under the exclusion class, one. And second, you talked about the contingent considerations. Is it like, more or less like a royalties, like over a period of time, if they are achieving a particular turnover or any particular achievement, then they are going to pay this much amount. So this will like, color of royalty. So how this going to be in the case of IFRS 17?
Yeah, good. I will answer one by one. The first one is your, whether contract, if the warranty is given at the time of entering the contract, because that's what the definition of sale. For IFRS 15 says, when you want to recognize revenue, you are supposed to follow the 5 steps. For if all the 5 steps are fulfilled, for a sale of goods or sale of services, of course, you have this, your percentage of completion method, which is still applied. That needs to be done. If the warranty is given at that time along with the sale, even though it is a sale of goods or a contract, it will be excluded. If the warranty is given later as a separate contract, then it will not fall under the scope exclusion. Then you need to apply IFRS 17. Coming to the second point, your contingent consideration is very specifically related to business combination. When an entity is taking over another entity. For what happens is this entity, there's nothing happens between Facebook and the WhatsApp company. It's actually the transaction is between Facebook and the shareholders of WhatsApp. Okay, that's what happens in business combination. So many times we think in a different way. Because nothing happens in the books of WhatsApp. It's only the stakeholders, only the owners of WhatsApp company is selling their shares to Facebook. Okay, so that is a very specific instance which is called contingent consideration. This royalty is nothing to do with it. The royalty comes only when you have an intangible asset which may boost the revenue of the other entity. So as a guarantee, the patent holder tells that you pay me patent right or the royalty based on the revenue increase. So that is a different context completely. So what is excluded is only the IFRS 3 issue. Yeah. So warrant, this patent will directly come under IFRS 15, the royalty thing, and the asset will be measured under IAS 38 intangibles. Welcome. Yes, sir. Good evening. Thank you. Well, the good news is Oman has not made any talk. You didn't even talk about it. In the year 2021 or 21, Central Bank of Oman sent a circular to the banks. Anybody from banking industry? Yeah. So they sent a circular telling that you will have to do something. They didn't say what is to be done. They told that they call green finance. So if you have any green finance, what's the meaning of green finance? Green finance means if a borrower is having sustainability related entities, and if you are lending money to such entities, you are supposed to put that in your financial statements in a separate category. So they just give a very vague trigger, that's it. After that, Cebu was keeping silent. Nobody talked about sustainability reporting in Oman.
Nothing has been raked up from this point of view. There
Yeah,
is.
so that's a good news for you.
And other one is,
But
also reporting
don't be
about-
resting too much, because you know very well how things operate in this part of the world. Suddenly one day they will come, next month onwards or next financial year and onwards, you are supposed to be doing your sustainability reporting. Be ready for that. That's what they are.
Because every day in LinkedIn, there is something or the other which is getting updated in this matters.
True.
As far as GRIs and this sustainability reporting is concerned. The other question is, how is the reporting amount specified or factored in the financials in hyperinflationary economic countries?
How the financial?
How is the reporting amount specified? Like
Reporting homes.
Like in the hyperinflationary
Yeah.
economies.
See, for example, if you are an entity in Oman and you have a subsidiary in Zimbabwe, for generally what we do, Zimbabwe, the financial statements will be in Zimbabwe currency. So you need to convert applying IAS 21, foreign exchange, foreign currency transactions. That particular standard is a huge standard. I have to talk about it half an hour. You know how to do the translation. I'm not talking about the transactions. It's a translation. For you, generally a nice balance sheet which is very well tallied in the Zimbabwe currency, you apply IAS 21 and you do all the P&L items you convert at the current rate, at the average rate. All the balance sheet items you convert or translate at the year-end rate. A nice tallied balance sheet now is not going to tally. So you create something plug called foreign currency exchange reserve, okay, and put it in the balance sheet as a reserve. Now that needs to be there in the OCI part, that's thing, until the subsidiary is spun off or subsidiary is no more a subsidiary. Now that's how you deal with that. Now here how you apply, if that particular currency is a hyperinflationary currency, then you have to do 2 times conversion. First, the currency, the original balance sheet which is prepared on the historical cost accounting of the Zimbabwe currency, you need to bring it to the current, so there's a formula given for each item. Basically it's a cost of living index. For example, if your property, plant and equipment which is at a particular rate, now it is at a different rate because of the inflation, because of the cost of hyperinflation, then you need to bring that. Mainly the current assets are the ones which get affected by that. Okay. Very true, very true. But you are going to do it on a particular day, and then you convert that into your local currency and you do the consolidation. So that's how it's going to be. It's a double exercise. Very difficult. That's why you're going to put a note telling that this was under the historical cost last year, and this year because of the hyperinflation we are going to do the current cost method. The good thing about the standard is it doesn't compel you to do the previous year changes, because that doesn't make sense. As I told you earlier, this standard was not invoked at all for a long time. It was made and forgotten. Many people don't know that this standard is still there in the book. Now, because of so many so many countries are identified to be hyperinflationary, and the currencies are affected, suddenly it got a life, and now the standard setters, the auditors, they are looking at it, and then if these many countries are there, if you have anything to do with, even if you have a debtor, if the invoice is made in their currency, if the invoice is made in your own currency, no problem. The question comes, if in your balance sheet, you're going to have that any item, any element, which is not in your currency, but in that hyperinflationary currency, then you will be hit by IAS 29. Well, every currency has if you go to the exchange for any currency, even for a currency in Timbuktu, you can have an exchange rate. Exchange rate is not a big deal. It may be zero, it may be very minimal, 0.0012 or something, but still it's having some value. That's it. If it doesn't have any value, then certainly you are not going to consolidate that entity, you are going to write off your investment. Sorry? I would say this is one of the easy areas to measure because there is something, financial metric is there, the currency rate. Either it is zero, if you are very pessimistic, it could be zero, it cannot go negative. Yeah. So your investment has to be certainly subject to impairment testing that time.
So again, lease accounting, and you recognize lease asset and lease liability. But there is a component of maintenance.
Yeah.
That is not available. The information is not available.
Well, if it is a lease asset, the maintenance will be on the lessor. It's not going to hit you.
But if you see, we are if you see the reporting in income tax, they will only allow the
lease rental. Yeah.
Lease rental.
Yeah. That is where the DTA comes.
So we don't have that benefit of.
Yeah. For your right of use asset on the lease liability becomes irrelevant in insurance. I mean, under income tax. Therefore, you need to create the deferred tax asset liability.
I am telling, going further, if you think further, yes, you can separate that maintenance expenses because some portion of it you are giving for maintenance.
Well, it depends on the lease contract, PRS. I mean, what type
because
of...
now,
Generally,
now,
in the lease, the main, even in our office, we use a photocopier. Why we take the photocopier on lease? Not because of lack of funds. It's because headache is not there. I don't want to bother about the maintenance. Suddenly the machine goes out. We just give a call, they come and do the work and go. So that's the purpose of... But maintenance doesn't have any relevance in this. Thank you.
Good evening.
Good evening.
My name is Babu Raj. I am asking regarding this IFRS 17 that warranty is excluded. Suppose if that warranty, if they are passing to an insurance company, that extended warranty normally the manufacturer will pass to an insurance company. So on that insurance company side also, it is excluded because they are giving the warranty insurance.
No, not at all. When he even transfers to the insurer, most of the companies that's what they do. If it is done together with the sale, then he is excluded from that. But if it is separately done, then he has to apply IFRS 17. In that case, he will become the insurer. The other company which is taking will become the reinsurer. Then IFRS 17 makes a special provision how to calculate for the reinsurer and how to calculate for the reinsurer. It will be treated two different ways, and the three models will be certainly applicable.
Yeah, because in this case, there is no reinsurer.
Yeah.
Only insurer. Because the manufacturer will transfer the risk because they are just selling the warranty.
Yes.
But they are transferring the risk to the insurance company. But
that's what I'm telling you.
Yeah.
If you are not falling under the scope exclusion,
yeah.
that means you become the insurer, the other company becomes a reinsurer. Okay. If you fall under the scope exclusion, then IFRS 17 doesn't apply to you.
Okay, okay.
Yeah?
The related question is if the entries are book backdated. So if we are trying to sell the warranty and we show that it is a part of the sale 6 months back. So in that case, because if suppose there is a bulk warranty sale business which is being done like 2 million, 3 million. So and if we decide to take advantage of that and because the financial year has not closed. So in that case, what would be the treatment?
Well, what you present is going to be accounted by that. So if you present it backdating it, you are saving your burden of applying IFRS 17. Well, that is the right thing to do, or in what intention you are doing it, that's a different question. Whether what will be the reaction of the management and the board and the auditors, all that involved. But moreover, in the case of insurance contracts, the dates are very, very important, as you know very well. So generally, insurers don't do, even the clients don't do that.
Can I ask a related question on
Yes,
another topic about the accounting estimates and accounting policy which
Yeah.
we were discussing? You made a point about the valuation of real estate when you talked about two points there, that if it is based on a market value concept or is it based on income approach?
Yeah.
Now that we considered it as a change in an accounting estimate.
Yeah.
Now regarding property valuations, what could be a change in an accounting policy as such?
Yeah, if it is investment property, if you are moving away from fair value model to cost model,
Cost model, okay.
certainly there is a change in policy, or vice versa.
Okay, thanks. Third question was regarding this IS 29. So basically I think you answered it, but just to reconfirm, if the counterparty is in a high risk country, in a hyperinflationary economy, and their debts are in USD, for example, then IS 29 won't be attracted, right?
Certainly, because the currency that matters, not the country that matters.
Yes.
The currency in which the financial statements are made, if that currency is a hyperinflationary currency, then you will be hit by IS 29.
Oh, thanks.
Welcome, sir.
Thank you, CA James, for a very insightful and informative session, very engaging. May I request Chairman CA Jim to felicitate our speaker.
I would like to especially thank also for your valuable time that you spent here, and Chairman and the Management Committee of Muscat Chapter for this opportunity for me to share this with you, and looking forward to meeting you again. Thank you very much.
We had a flower and organic kitchen competition announced in January this year up to March. So we are going to announce the winner as well. So may I request our chairman to announce the winner of organic kitchen competition.
So we would like to finish the first session with a green note, the sustainability initiative. As you are aware, we started a organic garden competition in January. A few members joined and we have formed a WhatsApp group to update the progress, and it was going on parallelly with our events. On June 5th, the Environment Day, we decided the winners. We had a very tight competition. Actually, our past chairman Sajeev ji is having a very good garden. Our treasurer Sangeeta ji is having a very good garden. But the winner is CA Nader Patel. I request him to please come forward and get it. And I also request PRS ji also to come and hand over the memento.
May I request Vice Chairman CA Gaurav for formal vote of thanks. After this, we'll have a group photo.
Okay, good evening, everyone. Although this will not be my first vote of thanks, but you will soon get used to listening me in the end with the vote of thanks as part of the Vice Chairman's responsibility at the end of each event. I think we had a brilliant first technical session, and I know based on various conversations with many of the chapters members, there was a specific request that there has been a long time that we haven't had an IFRS session. So taking that feedback into consideration was a key decision why we asked CA Ravi to be, James to be here and present this session. With this, I thank the past chairmen present, the senior members present today, our sponsors that have been there for the whole of last year and probably the time to renew the sponsorship. So I do request them to please renew the sponsorships for FY 23-24 as well. I also thank our CBFS who has been there supporting us since the inception of the chapter. With this, I conclude for today and hope to see you again in the next event. Thank you.
All MC member on the stage, CA James, please be on the stage for group photo.